All right, if you blinked in the last day, you missed one of the nastiest gut punches silver has ever thrown at traders. Yesterday morning, we were celebrating a brand new nominal high around $121 an ounce. And within roughly 30 hours, the market ripped the steering wheel out of everybody's hands and slammed down to the mid-70s intraday. Not a cute little pullback, not a healthy dip, a full-on trapdoor. And here's the part most people still don't get. In a real silver bull market, the violence doesn't only point up, it whips both ways. It does it fast, and it does it at the exact moment you feel most certain. It's Sunday, February 1st, and right now in New York it's 5:09 a.m. Comment what time you're watching this, because I want to see how far around the world this shockwave traveled. Quick thing before we go deeper. I'm running a campaign to eliminate copycat channels. If you value what I do here, subscribe and comment Our John AG so the algorithm knows who's real. Now listen, today's move wasn't just volatility, it was a lesson. It was the market teaching you what leverage feels like when it snaps back like a mousetrap. And if you're holding silver or you're thinking about buying it, you need to understand what just happened. Because the next part of this story is where most people lose their heads. In this video, I'm going to do 3 things in order, and the order matters. First, we're going to replay the week like a slow-motion crash test. What moved, when it moved, and why the drops didn't stop where people thought they would. Second, we'll talk fundamentals. What actually changes when price collapses like this, and what doesn't? And third, I'm going to explain the weirdest part of all, how you can have a chart that looks like a disaster, while the physical market underneath can still be screaming for metal. But don't skip ahead, because the biggest clue showed up right after the sell-off started, and it has nothing to do with your favorite headline. Before we jump in, check the description. There are bonus links there, including a premium WhatsApp channel link and a channel membership join link. If you like deeper breakdowns and you want to stay plugged in without the noise, those are there for you. Okay, let's talk about the bloodbath. The single most important thing to remember is this. Silver is not just a metal. In the modern system, it's also a levered paper product. Futures, options, swaps, structured notes, spread trades, synthetic exposure, layers on layers. And when the crowd piles into that stack, the stack doesn't gently unwind. It falls like a shelf collapsing. And when the market does that, it's not because everybody calmly agreed on a new fair value. It's margin calls, it's forced liquidation, it's risk managers yanking cords, it's exchanges and clearinghouses tightening screws. And yes, when moves get this violent, the futures complex reacts. Margins on key precious metals contracts can get bumped after a plunge, and that tells you the system felt the heat. So if anyone looks you in the eye and says, "This is normal, this is healthy," you can file that under people who haven't watched a real liquidation cycle up close. Now here's the cliffhanger. If this was only paper, then physical silver should have gotten cheaper everywhere, instantly, right? Except that's not what typically happens in these episodes. And we already saw signs that the physical side doesn't always obey the screen price on your app. Let me explain the standard playbook you're about to hear this week. You're going to hear, the run was too hot. True. You're going to hear, speculators crowded in. Also true. You're going to hear, it needed to cool off. Sure. But those explanations are incomplete because they don't tell you who was forced to cool it off and how. Based on recently published numbers from the derivative side, open interest can drop fast in moves like this. And when it does, it's not because everyone had a change of heart. It's because somebody got carried out. And that's where the next twist comes in. A lot of big players run silver exposure like a business model. Some are long, some are short, some are market neutral. But they all share one vulnerability. The moment volatility spikes, the math changes, and positions that worked yesterday become unmanageable today. There was commentary floating around that major players were underwater and that this flush gave them oxygen. That's plausible, because in a vertical market, even people who look smart can get trapped on the wrong side. But here's my skeptical alternative. It's not always a single villain or a single mastermind move. Sometimes the market breaks because it was built like dry tinder. All it takes is one spark, one sudden bid withdrawal, one wave of stop orders, one margin hike, and the whole thing lights up. And I'm telling you right now, this is exactly why I keep warning people to separate paper price from physical reality. Because while the chart was doing a waterfall impression, large bars in certain regions were still carrying ugly premiums. Let's talk about that, because it's the part that gets ignored in the memes. When Western benchmark prices dump, the first question I ask is, where are the big bars actually moving? The silver market has a geography problem. It's mined in one place, refined in another, stored in a few hubs, and consumed, industrially and as savings, in completely different parts of the world. That means flows matter. Over the last several months, we've watched a pattern that looks like this. Tightness shows up in one hub. Lease rates and short-term availability get strained. Then a big price smack happens, and suddenly metal appears, often pulled from vehicles that were never meant to be the last resort. Wash, rinse, repeat. Now, am I saying every downdraft is engineered? No. And you should be suspicious of anyone who says they can prove that with certainty. But I am saying incentives are obvious. If you can buy large bars in one market after a forced sell-off, and then deliver them into another market where end users are paying up to secure physical supply, you have a built-in arbitrage. You don't need a conspiracy, you just need a pipeline. And from recent market updates, we saw enough signals to believe that pipeline is still very real. One of the cleanest ways to see stress is backwardation, when the market pays you more for metal now than later. That's the market yelling, "Give it to me today." And even when screen prices crash, backwardation can linger in pockets where physical users can't wait. Now let's zoom in on the East, because this is where the story gets spicy. During the run-up, buyers in parts of Asia were paying a meaningful premium over Western benchmarks for sizable bars, and local rules and taxes can add another layer of cost. You can call that irrational, until you remember that manufacturers don't care about your chart aesthetics. They care about deliveries. And that leads to the next cliffhanger. What happens if high prices cause demand destruction, but shortages still happen anyway? Sounds impossible, right? It's not. A few days ago, there was fresh reporting that soaring silver has been squeezing solar manufacturers so hard that they're actively shifting designs to reduce silver use, and even pushing towards silver-free alternatives in some cases. That's a real counterweight. That's real-world substitution. That's why I don't buy the idea that silver can only go up in a straight line just because money printing. But it also creates a weird time lag. Substitution takes time, and factories can't retool overnight. So you can have demand trying to back away, while still needing metal right now. That tension is exactly where violent price action is born. Now keep this in mind as we talk inventories, because inventories are the silent scoreboard. This week, one of the most watched categories in U.S. exchange warehouses, the registered pile, the stuff considered readily deliverable, was hovering a little over 100 million ounces, and the direction has been down. That doesn't automatically mean we run out tomorrow. Warehouses have categories, owners can move metal between them, and not every ounce is for sale at any price. But it does mean something. The buffer is shrinking while volatility is exploding, and that combination is never boring. Now, before someone clips that line out of context, inventories can be replenished. Scrap can come back. Refiners can ramp. Miners can hedge. The market is adaptable. But adaptability has a speed limit, and when price moves this fast, the speed limit is the entire story. Let me put it in human terms. When people see a chart collapse, they assume the real world instantly gets cheaper. But physical supply chains don't update like an app refresh. Shipping doesn't teleport. Fabricators don't pause production because your broker alert went off. And large institutions don't rewrite procurement policies in an afternoon. That's why in episodes like this, you can have a paper dump and physical premiums that refuse to die. Now let me tell you a story, because this is where psychology destroys people. Back during the financial crisis era, I remember watching fresh buyers panic at the worst possible moment. Spot was low, fear was high, and people were calling around desperate to sell brand new coins for a loss because they couldn't stomach the drawdown. And I'm not telling you that to shame anyone. I'm telling you because that same emotion is hitting people again, just with bigger numbers. Back then, the screen said single digits. Today, the screen says double digits. But the feeling is identical. Make it stop. If you're successful, share your success story in the comments so others can stay motivated. Seriously, people need to hear from real viewers who kept their discipline when the chart tried to bully them. Now, here comes the part that makes the move even more important. The macro backdrop didn't disappear because silver had a tantrum. Debt levels are still enormous. Budget math is still ugly. And money supply dynamics are still a pressure cooker. Even if you think inflation slows, the refinancing wall, the deficits, and the political incentives all push in the same direction. More currency, more promises, more patchwork fixes. And in that environment, precious metals don't need to be perfect. They just need to be scarce, liquid, and outside someone else's liability. That's why I'm not looking at this week like game over. I'm looking at it like the market slamming the brakes to throw passengers forward before the next leg. Now, I know what you're thinking. Okay, John, if fundamentals are intact, why did price get nuked? Here's the simplest answer. Because silver can be fundamentally tight and still be financially fragile. Those two things can coexist. In fact, they often do. When price goes vertical, the market attracts leveraged money. Leveraged money makes the chart look stronger. until it becomes the reason the chart breaks. And once liquidation starts, it doesn't ask permission. It sells what it can, not what it should. That's why gold and the other metals got whipped around too. This was a volatility event, not a silver-only event. And it's why the gold-silver ratio snapped wider during the chaos. Now, we're going to get into the week's numbers in a second, but first I want to talk about what I think is happening in the plumbing. Because there's a reason large bars matter so much more than coins and small rounds in moments like this. Industrial demand doesn't show up in 1-ounce coins. It shows up in kilobars, 1,000-ounce bars, large format inventory that can be processed and used. Investment demand at scale also prefers big bars because they're efficient to store and transport. So when you see big bar premiums overseas, that's not a collector story. That's a supply chain story. And if you're wondering why this keeps pulling metal from west to east, it's because that's where a lot of the incremental manufacturing growth has been. Electric vehicles, grid hardware, consumer electronics, solar build-outs. Silver is embedded in the modern electrification push. And even if some sectors try to thrift silver away, the transition itself still consumes metal. From recent market updates and publicly available industry estimates, solar alone can require on the order of well over 100 million ounces in a year, with EV growth adding meaningfully on top of that. Forecasts are forecasts, but the direction of travel is clear. Now let's slow the tape down, because when you look at a single daily candle, it hides the real drama. Silver doesn't trade like a stock with a clean opening bell and a clean closing bell. It trades in overlapping sessions, in waves. Liquidity changes as the sun moves. And in weeks like this, the thinnest window becomes the most dangerous window. Here's the sequence that usually happens when a move turns into a free fall. First, price starts slipping and you get the initial wave of profit taking. That's normal. Then, the stops start triggering. Not because everyone changed their mind, but because most leveraged accounts have automated exit points. Those exits are literally market orders when the level breaks. Then the market hits the next layer, options hedges. If dealers are short calls into a rally and the rally reverses, they suddenly don't need as much upside hedge. They sell futures to rebalance. That selling pushes price lower, which forces more stops, which forces more hedging. It's mechanical. And then you get the real killer, margin calls. When volatility explodes, your broker wants more collateral. When the exchange increases performance bond requirements, your broker may want even more. If you can't post it, you don't choose to close the trade. The trade gets closed for you. That's why liquidation always looks like a stampede, because it is. What's wild is how fast this can cascade across metals. Gold gets hit because it's liquid. Platinum gets hit because it's small. Mining stocks get hit because they're a risk asset in disguise. Even if the original spark starts in silver, the fire spreads wherever there's leverage. Now let's talk about the ratio, because it tells you what kind of week this was. When silver is ripping, the gold-silver ratio usually compresses, meaning silver is outperforming. That's what we saw during the run-up, when the ratio pushed down into levels we haven't visited in a long time. Then the flush happened, and the ratio snapped wider again. Not because gold won, but because silver was the crowded side of the boat. When the boat tips, the crowded side goes underwater first. Historically, that ratio has spent a lot of time in the 60s and 70s. It can go far lower in a mania, and it can go far higher in a deflation scare. So if you only watch one number to understand how extreme sentiment is getting, that ratio is a good candidate. And here's the cliffhanger. If the ratio can widen this fast in 1 week, it can also compress this fast in 1 week. The market doesn't need months to shift. It needs hours. Now, you might be thinking, okay, fine, paper got crushed, but what about the physical market everyone keeps talking about? Let's be honest. The physical story is always messy because physical is fragmented. You've got industrial bars, you've got retail products, you've got vaulted bars in investment vehicles, you've got private storage, you've got government stockpiles in some countries. And every one of those buckets has different incentives. That's why you can't reduce physical to one number in one place. But there are a few recurring tells. One tell is premiums in regions where end users must keep production running. If they can't pause, they pay up. Another tell is warehouse drawdowns in visible exchange systems. Even if those systems don't represent the whole world, they represent a place where people can actually demand delivery. And when visible piles shrink during a volatility storm, you pay attention. Another tell is financing stress, lease rates, borrowing costs, and the availability of metal for immediate settlement. You don't need to be a banker to understand the concept. If it's hard to borrow, it's scarce. Now, the competitor narrative you're going to hear a lot is, this was a contrived smash to free up bars. Maybe. But here's a more grounded way to think about it. When prices run up fast, Big holders of metal have an incentive to monetize some of it, especially if they can do it through structures that are easy to redeem and easy to ship. At the same time, manufacturers who can't tolerate supply interruptions have an incentive to lock in inventory even at elevated premiums, because the cost of stopping a factory line can dwarf the premium paid for raw material. So you end up with a situation where the chart is falling, but the real economy still has a bid, and the metal moves accordingly. That's why I keep circling back to the west to east flow idea, not as a cartoon villain story, but as a simple gravity story. Metal moves toward the highest urgency buyer. Now, because we're keeping this practical, here's what you should watch when it comes to big bar tightness. Watch the spread between local benchmarks and international benchmarks. Watch import frictions, taxes, capital controls, shipping constraints. Watch whether local exchanges tighten risk controls when volatility hits. That's exactly what happens when volumes get spicy and they don't want disorderly markets. And watch how quickly warehouse stocks refill after drawdowns. If stocks refill quickly, the market is flexible. If they don't, the tightness is real. Now, I want to talk about fresh data for a second because I know some of you think everything is just vibes. It's not. From recently published industry commentary, the silver market has been running multi-year structural deficits, and the last year was still expected to come in short by a meaningful amount even after higher recycling. Again, deficit doesn't mean straight line up, but it does mean the market doesn't have a huge cushion if investment demand returns hard. And investment demand can return hard. We just watched it happen in gold. Now, let's bring it back to the psychology shift we just talked about. By the end of the week, silver was sitting in the mid-80s on the futures screen, after printing that insane low in the mid-70s intraday. Gold had tagged the mid-5,000s at one point this week, and then got dragged down with a sell-off to close under $5,000. And here's the emotional whiplash. A year ago, those closing prices would have sounded like science fiction. Today, after a crash, they feel like a loss. That's how fast psychology shifts. But here's what most people miss. Even a crash can be bullish in one way. When leverage gets flushed, the market often becomes healthier for the next move because weak, forced sellers have already been shaken out. That doesn't guarantee an immediate rebound, but it changes the character of the market. That's why I don't laugh at people who say this was a reset. It might have been. I just refuse to pretend it's automatically a reset that guarantees higher highs next week. The market earns that with follow-through. Now, layered on top of the metals chaos, we also got a reminder that financial stress doesn't take breaks. There was a U.S. bank failure announced at the end of the business day on Friday, with regulators stepping in and deposits being assumed by another institution. I'm not bringing that up to fearmonger. I'm bringing it up because it's the kind of headline that often shows up when rates, liquidity, and asset prices are all pulling in different directions. And if you think bank stress has no relationship to metal demand, look at history. When confidence shakes, people reprice risk. Sometimes they rush into cash, sometimes they rush into hard assets. Often they do both, just at different times. Now, this is where gold's story matters. We just got confirmation that global gold demand in 2025 hit a record level, with investment demand surging and central bank buying still sitting at historically elevated levels, even if it cooled from peak years. It reminds me of wartime paper money panics. When confidence cracked, people ran to metal, and the government held hearings over phantom claims. Same instincts, new scale today in the market. And when gold demand runs like that, silver tends to get dragged into the narrative, sometimes as the cheaper cousin, sometimes as the industrial wild card. But silver behaves differently. Silver is the metal that can look sleepy for months and then go feral in a week. And when it goes feral, the leverage gets exposed. Now, there's another angle that most people miss during the run-up. Volatility itself becomes a catalyst. When implied volatility spikes, option books get rehedged. When option books get rehedged, dealers buy or sell futures to stay neutral. When dealers buy or sell futures, the underlying move gets amplified. It's a feedback loop. That's one reason a blow-off can look unstoppable, until it suddenly reverses like someone turned gravity up, which leads to the next cliffhanger. What happens when the market reopens in Asia after a weekend of people staring at that chart? Because the first real test of a crash is not the crash itself, it's the bounce attempt. If premiums stay sticky and physical buying steps in, you can get a violent snapback. If buyers freeze and everyone tries to wait for lower, you can get a grind down that feels like slow torture. So here's what I'm watching as we roll into the new week. 1. Do the overseas physical premiums compress, or do they stay elevated? 2. Do we see continued drawdowns in the most visible warehouse categories, or do inventories stabilize? 3. Does volatility stay high, forcing leverage to keep exiting, or does it cool enough for normal risk-taking to return? And 4, this is the sneaky one, Do industrial users start locking supply on dips because they can't run their operations on wishful thinking? Now, earlier I said I don't buy simple narratives, so let me challenge one more popular claim, that silver can only go higher because there isn't enough silver. Yes, the market has run structural deficits in recent years, but deficits don't automatically mean price only goes up. A deficit can be covered by inventories. It can be covered by recycling. It can be covered by delayed demand. It can be covered by substitution. A deficit is a pressure, not a schedule. That's why you have to think in phases. Phase 1. The story catches fire and money floods in. Phase 2. Leverage builds and price overshoots. Phase 3. The market flushes the leverage. Phase 4. The real trend reveals itself. Either fundamentals reassert or demand breaks. Today we just lived through a Phase 3 moment, and the scary part is we may not be done flushing. But the opportunity part is we may not be done trending either. That's why I keep repeating, don't confuse volatility with direction. Now, let me make this practical because a lot of you are asking the same question in different forms. What do I do with this dip? I'm not going to tell you what to do. I'm going to tell you what to think about. If you're trading leverage, you need rules, stops, size limits, and the humility to admit silver can move farther than your account can survive. If you're stacking physical, you need patience. You need to expect premiums, delays, and moments where the screen price feels disconnected from what you can actually buy. If you're a long-term holder, you need to decide right now, before the next candle, what would make you sell and what would make you add. Because if you don't decide now, you'll decide later in a panic. And panic decisions are expensive. And if you're new, hear me on this. The first bull market you live through will try to trick you into doing everything backwards. It will make you want to buy after euphoria. It will make you want to sell after pain. That's the trap. So here's a question for you. Do you think this crash was mostly forced liquidation, or do you think it's the start of a bigger shift where demand actually cools off? Drop your take in the comments. One sentence, no fluff. And here's another. If silver bounces hard this week, are you the person who chases it, or the person who waits for confirmation? I want honest answers. If you're successful, share your success story in the comments so others can stay motivated. The comment section becomes a playbook when people actually tell the truth. Now, I promised I'd keep the promos short, so here it is. We do members-only videos too. Those are produced by a separate team with more research and tighter breakdowns, and they're only for premium members. If you want the deeper cuts without me having to keep every segment YouTube-friendly, the join link is in the description. All right, back to the market. One of the reasons silver feels like it's breaking the system is because it's small relative to global capital flows. A modest amount of money, when it decides to pile into silver, can create outsized moves. That's also why the unwind looks like a cliff. And it's why I keep telling people, you can't treat silver like a slow-moving bond. It's a sprint animal. Now, zoom out for a second. When currencies get pressured, when real yields wobble, when debt debates get louder, metals tend to get attention. But the path is never straight. In the 1970s and early 1980s, silver went parabolic and then collapsed. In 2011, silver surged and then got punched down hard. In 2020, silver dropped with everything else and then turned around. Different triggers. Same human behavior, crowding, leverage, liquidation, and then narrative reconstruction afterward. So when you see commentators racing to explain today's candle, remember, they're mostly describing the aftermath, not predicting the mechanics. The mechanics are simple. When the market is overloaded, it breaks. Now, here's what I think today's break tells us about the months ahead. First, volatility is likely to stay elevated. Once a market prints extremes like this, it doesn't instantly become calm. It trades in bigger ranges because participants are traumatized and position sizes get recalibrated. Second, pricing power is shifting. High silver prices are already pushing some industries to innovate away from heavy silver use, which could cap demand growth in specific applications over time. Third, the financial system is still fragile in spots. A bank failure headline in January isn't proof of a crisis, but it's a reminder that tight conditions expose weak links. Fourth, and this is the big one, if investment demand stays strong across metals, dips can get bought aggressively, even after scary corrections. So if you're waiting for a world where everyone suddenly stops caring about hard assets, you might be waiting a while. Now, I'm going to say something that might annoy both extremes. To the permabulls, you're not owed a straight line. To the permabears, you're not guaranteed a collapse just because a chart finally breathed out. This market can whip both sides and take trophies. The goal isn't to be right. The goal is to survive long enough to benefit from being right. That's why I'm watching the open in Asia like a hawk. Because if the physical bid shows up again, even after that kind of damage, then we're looking at a market that is not done. And if the physical bid disappears, then the next leg down could be quieter, slower, and psychologically worse. Either way, the next 24 to 48 hours matter more than 1,000 hot takes. So here's what I want you to do before the next candle prints. Check your exposure. Check your time horizon. Check your emotional triggers. And if you're buying anything, metal, miners, ETFs, futures, make sure you understand what you actually own and what can be taken from you in a crisis. Paper promises can be settled in cash. Physical assets can't be cash settled if you actually hold them. That distinction is the entire game. Now I'll leave you with one last cliffhanger. The market didn't just fall. It revealed where the weak hands were hiding. And the next move, whether it's a snapback or another flush, is going to reveal something even bigger. Whether the world is repricing silver as a strategic input, or whether it was just a speculative fever dream. Either way, we're not going back to normal. Not after this. If you found this useful, hit subscribe so you don't miss what comes next. And keep an eye on the description for those bonus links, including the premium WhatsApp channel and the channel membership join link. All right, that's it for now. Take care of yourself and take care of the people around you. And remember, I'm here to share my thinking and help you learn. This isn't financial advice, and I'm not telling you to buy or sell anything. Use this as education, do your own homework, and make decisions that fit your situation and your risk tolerance.